It's no surprise that Tesla posted a lackluster earnings report in a world that seems to be on the brink of World War III, accompanied with sky-high inflation and interest rates. People are not exactly clamoring at the idea of buying an expensive electric vehicle right now that, if financed, will entail a monthly payment number that seems fit only for home mortgages. We're in a very tough and uncertain spot right now in many ways. Considering all of this, I suppose Tesla posted a good report in that they are still growing and cash flow positive. Perhaps due to the high standard we've come to expect after Tesla seemed to only win and always figure it out the past few years, means that a good quarter, generally speaking, and a good quarter for Tesla are two very different things. This was the first earnings call I can remember that did not leave me inspired and optimistic. Elon Musk sounded exhausted and perhaps even depressed at points. While long term, I still think the company will do great and I still believe in it, it's my largest holding, I think the next 12 months could be rough, so buckle up. The market seems to agree, with Tesla down 15% the past week. Let's look at the takeaways. So some of the positives were that Tesla continues to drive down costs, both through economies of scale and a relentless drive to optimize. In reading Walter Isaacson's biography of Elon Musk, this comes up again and again. There's a sheer determination to continuously improve efficiency at Tesla under the helm of Elon Musk. Since Tesla's inception, Elon has personally patrolled the factory floor, asking why things that seem silly or slow down the production process are necessary, and wherever possible, deleting said bottlenecks. This trend will continue and is at least partially offsetting decreases in the average sale price of the cars. As you can see in the chart, the cost per vehicle is down $2,000 over the past year. That's over a 5% increase in efficiency in 1 year, while also ramping multiple new factories. Show me another company manufacturing complex, expensive products that cuts costs by 5% in a single year. Tesla stated that they continue to believe that an industry leader needs to be a cost leader, and they are definitely leading by that example. Another bright spot is energy storage deployments, which increased 90% year over year. Tesla's megafactory in Lathrop produced 4 gigawatt hours in Q3, and at full capacity will be able to produce 40 gigawatt hours a year. On to the other stuff. In the report, they stated, our main objectives remained unchanged in Q3 2023, reducing cost per vehicle, free cash flow generation, while maximizing delivery volumes and continued investment in AI and other growth projects. As I combed through the report multiple times, it didn't seem as bad as at first, and I refer back to what I said at the beginning of the video. I think any company that's able to show growth right now is very impressive when you think about all of the headwinds, especially for a company like Tesla, yet they're still on track to grow their vehicle deliveries around 50% year over year. As Elon stated on the call, I mean, at the risk of stating the obvious, it's not possible to have a compound growth rate of 50% forever, or you will exceed the mass of the known universe. But I think we will grow very rapidly, much faster than any other car company on Earth by far. Now, while profitability has gone down significantly, we already knew this was coming for, as it had been guided for. They stated our main objectives remained unchanged in Q3 2023, reducing cost per vehicle, free cash flow generation while maximizing delivery volumes and continued investment in AI and other growth projects. This seems to be the right approach, and Tesla has been balancing the two very well by producing free cash flow, even if it's down, while also investing a ton back into the business. Tesla has a very strong balance sheet. As long as they continue to generate some free cash flow and simultaneously continue to invest in the future, their position is only growing stronger. As you can see in the red column, the current quarter, Q3, you see the company generated $3.3 billion in operating cash flow and spent an all-time high on capital expenditures, over $2.4 billion in the quarter. So they were able to reinvest into the business 20% more than the prior 2 quarters, while still generating $848 million in free cash flow. This is amazing, and this is a very efficient business. Their cash position is now up to $26 billion, and the balance sheet remains a fortress. Just think about all the debt lots of other companies, especially the auto companies, have with the rising interest rate environment. The company also stated, during a high interest rate environment, we believe focusing on investments in R&D and capital expenditures for future growth while maintaining positive free cash flow is the right approach. There's no question Tesla is by far the most well-positioned company in the auto market. Plus, it is still the only company producing electric vehicles at a profit. So in conclusion, the company stated, while we continue to execute on innovations to reduce the cost of manufacturing and operations, over time, we expect our hardware-related profits to be accompanied by an acceleration of AI, software, and fleet-based profits. The long-awaited Cybertruck delivery event is slated for November, and this is a product sure to generate a lot of buzz. Tesla will prudently continue to optimize and invest for the long term. You know we're heading into uncertain times when a company like Tesla, that seems to always move at warp speed, has deferred to a cautious approach, at least for the time being. That's all for today. If you enjoyed the video, don't forget to like and subscribe, and I look forward to hearing your thoughts on Tesla in the comments below.